everyone. Today is Friday, March 17th, 2023. My name is Evan. Welcome back to another edition of Stock Market Weekly. This is episode 675, presented by The Trade Risk, where it is our job to break down the most important trends, price action, and noteworthy moves that you may have missed across financial markets. Lots still going on out there, so let's just jump right into it. We still are in the midst of this banking crisis, this financial crisis. It started last week. We talked about it at length, basically on how everything got kicked off here, and the market is still sort of sniffing out and worried about contagion effects and getting liquidity pumped back into the system. Is it QE? Is it not QE? I know there's lots of debates out there, and folks seem to be upset whether or not you label it a certain thing. But the point is, we do have the Fed out here supporting these financial institutions, and we're getting a flight to safety rotating pretty aggressively into treasuries. We see interest rates, we see yields falling like a rock over the past 5 or 6 days from the short end of the curve all the way out to the 20-year plus. We are seeing those rates, those interest rates drop. We do have the MOVE index, which is also exploding to new highs. And if you're not familiar with the MOVE index, it's basically the VIX, the S&P 500 VIX for treasuries, for fixed income. And so that's exploding to highs. And there's a bid in technology now, as there seems to be, this new sort of sense that interest rates aren't going to be higher for longer, like Powell has essentially drilled into the market over the past month. The market finally, over the past month or so, finally believing, Powell saying that we are going to be longer and or higher for longer. And now suddenly over the past 5, 6, 7 days, everything seems to have changed here with, our financial system at risk of sort of contagion and all the like. So it has been wild out there. We saw the Fed balance sheet basically retrace 50% of its entire quantitative tightening process over the last 10 trading sessions. And meanwhile, we've got this new sort of equity market volatility regime that seems to be sticking around here. This isn't just a blip and, kind of fade the fear and fade the pop in fear. It does seem like it's sticking here. So let's get into the numbers. If we look at the market this week and we look at this right-hand column, this is the 1 week returns. And, you're going to see something standing quite clearly out by itself, and that's the Nasdaq 100, up nearly 6%. And meanwhile, take a look at the Russell 2000, down almost 3%. This is one of the biggest spreads that we've seen in quite some time between growth and, if you want to call it, value. I mean, the Russell is got a lot of small financials and energy stocks in it, and those were the hardest hit. But this spread is pretty extreme here. The S&P 500 still enjoying things despite all of the chaos that seems to be going around. 1.36%, again, very market cap dominated. We're going to look at what the equal weight looks like later. And international stocks kind of somewhere in the middle. But clearly now you've got just this very big tech standout. There seems to be technology and there's everything else. And when we look at our market trends, I mean, basically, you're seeing this start to come through here as well. If we look at the Nasdaq 100, it's the only bullish on the short and medium term out there for all of the major indices. You can see the S&P 500 still has a medium term kind of positive signal here, but everything else is sandwiched between some fairly bearish price action and from a trending perspective across these multi-durations. Now, volatility is a problem here. So volatility environment is sticking here in the mid to upper 20s. That's, basically a place and point here where nothing good can really happen. Now, for to be very clear, something good has happened here this week, right? The S&P and Nasdaq have been able to rally in the face of this new high volatility regime, but I feel like something has to give here. And, with NASDAQ fall up in the upper 20s, nearly 30, you can see the Russell is over 30 and the VIX is sticking around 26. Notice that, markets, is particularly the NASDAQ here, was up 6% this week, but its volatility continued to rise this week, right? That's typically not what you see. You see in healthy market environments, up moves, down volatility. It's this inverse relationship, but you're not seeing it here. You're seeing it and in fact, volatility rise with these rising prices. And so that leaves us to be at least a little bit on alert, at least traditionally. It should get you asking maybe some questions. Now, as we mentioned at the top here, this is a picture. I was looking to who to attribute this to, but seems like everyone was out there talking about it, and this chart's everywhere. This is from Bloomberg, but basically it's just showing the Fed balance sheet here. And you can see essentially since late 2021, when the Fed started its quantitative tightening, and we were slowly kind of trickling down here, it's taken, all of 10 months, 11 months, almost an entire year of quantitative tightening. And then here it is with this big spike this week where the Fed's balance sheet just increased $300 billion and basically, gave back in 10 days, a year's worth of quantitative tightening. So clearly the market is kind of, forcing the hand here of the Fed to kind of move back to some easy policy. We'll see obviously how this gets followed up. Can they continue tightening from these levels? And what breaks if they do? Those are all big questions that I certainly don't have the answer to. But that's certainly notable. Charlie Bolello here, who I love his research. Give him a follow on Twitter. This is directly from him, and this is pretty remarkable. But of course, in the past 6-7 days now, the market has basically gone in from pricing in a terminal rate here towards the end of the year. It was before this, it was almost 6% of what the market was expecting to finish off the year in 2023 in terms of a Fed funds rate. It's like 5.75% or so. And now it is pricing at almost a 100 basis point cut in rates. So going into December now, market's getting, less than 4%, 3.99%, 3.75%. This is a couple of days old, so I'm not sure where it precisely stands at the time of recording this, but needless to say, again, all of the action that has unfolded here over the past 5-6 trading sessions has certainly thrown a wrench in the plans that we were training on over the course of February and early March. Also, final slide here on interest rates. Next week is Fed is meeting, and they're going to give us our new Fed funds rate for the March 22nd meeting. And right now the market is kind of split here, and so the overwhelming majority, though, 62% chance that we are only raising 25 basis points. And you can see now a 38% chance of a 50 basis point rate hike next week. So clearly, we're coming back down. If you look over the past day, over the past week, look at, 1 month ago where we stood, and you can clearly see that the market is kind of all over the place, sort of recalibrating its expectations here, over this next Fed meeting. So it's going to be interesting, should lead to some, volatility and some, adaptive pricing, depending on what the market, what the Fed comes out with on next week's meeting. So let's get back to the numbers here. That's sort of the macro high level interest rate discussion, but it's important because it drives, certainly a lot of, equity market behavior. But now if we get a little more granular here in terms of equities, in terms of stocks, and we take a look underneath the hood, the 52-week highs and lows, you can see there's really been nothing good here. In fact, you're starting to get more days of strongly negative numbers here, or said another way, strong number of stocks hitting new 52-week lows. And on the week here in aggregate, you had almost 1,000 net negative stocks making new 52-week lows. So that clearly is bearish positioning or bearish behavior here. The number of stocks at highs is clearly dried up, and we are starting to clearly just fall into the trending lower camp in terms of market breadth. Now, if we take a look at IBD, shout out to IBD. They make this show possible. They sponsor a lot of our content, so do support us, support the show, support IBD with this link here. If you want to get access to their digital subscription, we've got links in the description, or you can follow this bit.ly link here. But this is their put call ratio. Again, not theirs. It's just posted, updated daily in terms of their digital subscription, along with other things. But you can see that we did get north of almost up to about 1.2 in the put call ratio here, and that was earlier in the week, and that really did coincide with kind of that temporary, at least temporary, I'm calling it, bottom in the S&P 500. We got a nice rally off of it, and now we're back below 1. So again, keep an eye on this. This is a good sort of kind of a counterintuitive or a counter trend sort of play. When you get big spikes here in put call ratio over, usually over 1, you want to start paying attention to it, but really over 1.1, 1.15, those can typically, mark some type of short-term bottom. Now, sector performance on the week here, clearly you've got a split market. You've got deep red, deep green. On the green side, technology, communication services, and utilities. All of these here getting a nice sort of rotation, 4 to 5.6% of upside. Very constructive, very good action. But when you look on the downside here, it was energy, it was financials, and materials that were down almost the same. So from 3.5% to 7% to the downside. So it was a very split market here. Financials, clearly we know what's going on there. Energy sector, certainly feeling some pain. Crude oil broke down this week, and we're seeing some breakdown or continued pullbacks in the energy sector. On the 1-month numbers, you can see just about everything is still red, except for technology did manage to now finally claw into positive territory looking back over the past month. Now, Treasury yields, again, like we talked about, falling like a rock. We've got the 10-year yield now below 3.5. It closed actually 3.395. So this is a huge move down. Just really a week ago, or I guess 10 days ago, we were, north of or around 4%, and now we're around 3.4%. So this is some pretty big, again, unwind here as a lot of folks rotate into Treasury bonds, which, push down Treasury yields. Now, dollar and commodities, Bitcoin, big winner this week, 21%. Bitcoin, Ethereum, crypto has been enjoying this turmoil in the banking sector. It is like it was born out of the financial crisis. If you think back all the way to when Bitcoin got its start, why it emerged as a cryptocurrency to begin with, it was during the depths of the great financial crisis back in 2008, and all of this sounds and smells pretty similar. You've got Bitcoin rallying, silver and gold also rallying here. These sort of alternative currencies, call them. Dollar index was down 0.5%. Ag, copper, natural gas all down slightly, but crude oil was down big here, 12.65%. We're going to talk about that in part 2. Last but not least, our 2 trading systems here. So basically, our longer term system, Merlin, has been getting stopped out of some things. It's been reducing exposure sort of naturally in terms of stop losses and its risk management procedures. So it is now about 48% invested here and essentially been raising cash throughout the course of this week. Our short term trading system is 7% invested on the long side right now. And again, really trading on the long side right now. It does have at least a short position on, does have couple of long positions still on as well, but pretty balanced, pretty neutral, pretty, waiting and seeing. A lot of turbulence out there, and so it's staying pretty agile and non-committal to this market. Overall, 26.5% invested across the 2 systems. So these are our quantitative fully rules-based trading systems. I have no input into them. I, of course, designed them, but they run without my discretion and input, and they are available as a signal, but really portfolios themselves, and they are available on our website. Get nightly trade reports. You can see what they're up to. Take a $1 trial, see if they're right for you, and with that, we will get started here with part 2. All right, here we go. We've got TC 2000 open. We've got our S&P 500 chart, cash settled market that we're looking at, and we're currently on a daily time frame. So this week, we came into the week, so let me actually dial it back. Last Friday, when we did last Friday's market video, we were finishing the week here, right? So we had this high volume kind of breakdown. We did note basically the only bullish thing we could really point to last week was the fact that we were oversold. We were piercing below that lower Bollinger Band. And that was enough this time, actually, right? We, of course, had some actions, right? Last week, we had the big uncertainty. What was the Fed going to do? Were we going to bail out Silicon Valley Bank? And all these questions. And of course, we clearly know the response. We've got, liquidity effectively injected into the system once again. And that certainly was enough to put in a bottom here in the S&P 500. Now, as it stands, we did reclaim as well this 3,900 zone. So 3,900 has been pretty much a key inflection point. We've talked about it at length here, going back many months, and we did reclaim that. So net, that is good. The market did do a little bit of repairing this week. Volume was certainly higher this week, and we did close again on a weekly bar towards the upper end of the range. So all in all, not too bad. The problem I have is that we have, again, other things that are suggesting that this market may not be the healthiest, as healthy as maybe the price action here is leading us to believe. So first off is the VIX. The VIX here back up 25, and I mean it's moving, and it's got some big ranges going on here. We talked about the VIX last week. We talked about the fact that we got this initial spike up, and when you get these big spike ups, I mean certainly what I like to see if I'm playing on the bullish side is pretty much an aggressive fade. You want to see that fear spike in, a lot of protection get bought up, and then you want to see that kind of roll back over and start to drift consistently lower anyway. And here, it's a little bit unclear. I mean, we've been chopping around here, and I'm not a big fan of doing a whole lot of technical analysis on the VIX per se, but to me, it's really just the level, the magnitude, right? Like, where are we? And Friday was a quad witching day, so we'll see where we end up Monday, when really options are sort of reset and new hedges are potentially put on. But for now, VIX at 25 here is just is an uncomfortable spot, because as soon as we start getting north of 25 and upper 20s, and God forbid 30 plus, this market can really start to fall apart. And we know what that looks like. Just dial it back, a handful of months. So the actual volatility regime is concerning. Again, you can go to all of the big indices here. You go to the Nasdaq vol, which is at 28. We already talked about the Russell vol, et cetera, et cetera. So that's a bit concerning. You also have breadth, which we talked about in part one, right? We have a lot more new lows being made than new highs. That is a bit concerning here. And let's look at something we don't often look at, just again, really just a breadth play here, but this is the equal weighted S&P 500 index. Throw it on a weekly chart, and the equal weighted S&P 500 closed down almost 2% this week. So clearly, not being, when you take away the big mega cap, Microsoft, Apple, Google, Amazon, then you're left with a much more bleak picture here. And this obviously, again, speaks to breadth. So with those kind of things combined here, yes, I'm encouraged the fact that we did start to, close the week towards the highs and recovered some damage here. But to me, it feels more like just working off some of these extreme oversold conditions. I want to see how we follow up next week. And especially, with the Fed on deck next week, we've got catalysts here. So I think, really glass half empty. I would sort of look at this as more like, well, maybe this is unfortunately going to be some type of bear flag here. Again, I'm not placing this bet. I'm not making any big bold calls, but it seems to me like this could be some type of setup here of a bear flag. But again, we don't know, and we'll just see. But this is, clearly a scenario that we want to be careful of. If we start to break down below 3,900, we start losing this critical kind of prior inflection point while VIX is up here. Well, I think you know what to do at that point. It's run for the hills, get defensive, or hedge a little bit depending on your time frame. So S&P 500 again held the line in here, but it still looks a bit dicey. And when we go to switch over here, go to the Russell 2000 next. I mean, Russell 2000 is totally just rolling over, breaking down here. Very heavy volume. You can see, again, down 3%, closing towards the lows of the week. Obviously, this has a little more of the exposure that's getting hit the hardest right now. But clearly, you can see this kind of, rolling back over here, falling back into this old range that it was in for, most of last year, and really just again, zooming out hasn't changed the picture a whole lot. It's still a sideways market, but it clearly lost all of that upside momentum it had towards the first month and a half of this year. So unfortunate to see for the Russell 2000. Again, if we look on Bollinger Bands here, it's just kind of riding this lower Bollinger Band here. And really, unlike the S&P 500, couldn't even muster up a bounce. It just had one single day, and then it's just stuck like glue back to this expanding lower Bollinger Band. So still some trouble trouble here. Again, can it mean revert? Can it bounce at any point? Yes. There is a tremendous amount of volume coming in here. So volume peaks at usually inflection points. So we'll keep an open mind, but clearly getting hit the hardest. And when you go to the total 180 here, you go to the Nasdaq 100. And if you're bullish on this market, this is what you're spending your time looking at, talking about, and sharing on Twitter right now. Nasdaq 100 just clearly in its own lane right here. Look at this nice, beautiful, bullish engulfing weekly bar that it put in on heavy volume. Again, in isolation, this looks great. This looks nice and strong here. I still have concerns and some doubts about it. Again, I'm not going to front run them. I'm going to let price action speak, dictate the path here. For me, I want to see, 310 taken out. I want to see follow through. Again, get through the Fed. Can we actually follow this up? And, more importantly, let's get this NASDAQ vol back down into the low 20s at least, right? I mean, I know NASDAQ runs a little richer in terms of its vol premium relative to SPY, but still up around 28 or so. Rising volatility while the NASDAQ rises 6% on the week. I just get a little bit concerned. My little radar antennas go up, and I just want to be cautious. So I enjoy the move. Again, if I'm going to be long, I suppose Q is better than SPY, but we're coming into resistance now. We're up 5 days in a row. We've got, FOMC out next week. Fed funds rate out next week. So let's see how this does. 310. I mean, 310, if you're starting to clear over 310 though, this can easily start, continue to squeeze here, and it just would be a tough short, right? I would not want to be short this over 310, but I don't necessarily have to love it right here at 306 as we have resistance above us. So I like the move. I like the relative strength. But again, this overall environment here, some of these other things are still just telling me to be a little bit cautious on here. So again, know your time frame, know your risk tolerance, all that good stuff. If you're in this trade, if you're trailing a stop, all that, then, great job. And let's see if it can continue to move next week. So that, I think, kind of covers everything on the major indices. Thoughts there. Let's look at some other markets because there's a lot of other things going on. Gold. Take a look at this week in gold, 5.56%. Let's see if I can actually throw up my rolling returns. And this is a TC2000 indicator. Yep. So basically, if you are a TC2000 user, you can get this on our website, but this is daily movements displayed in ATRs, and you can see this really eclipsing here, showing that it is, in fact, a meaningful move. It's one of the largest moves we've seen going all the way back to 2021. It is happening on the upside. Volume as well, really kind of off the charts here in terms of general magnitude for gold. So yeah, it's clearly standing out here. It is breaking and moving back up to the top of a multi-year range, doing it on heavy volume. Yes, Bollinger Bands are expanding, but it's riding, getting back up to that upper Bollinger Band on the weekly chart. On the daily chart, it's definitely eclipsed it, right? So if you're chasing here, then just know that you're chasing. This is, a tougher spot to get involved in today. But certainly here from a technical momentum perspective, gold obviously looking wonderful here as a flight to safety trade right alongside treasuries and everything else. Again, watch the dollar, watch obviously the Fed reaction next week. This can easily pull back pretty aggressively given the fact it's moved up so much, but pullbacks at this point might be opportunities, but just be careful chasing. But huge move for gold. Congrats to the gold bulls out there. Silver, pretty much the same thing. I mean, 10% to the upside, getting even more juice. The structure here is much different though, right? Because silver's not up to its multi-year highs. It's, kind of coming and trying to put in this higher low. So again, still looks great. Still has a tremendous amount of up volume coming in this week and a nice kind of breakaway, breakout bar. But it's just, looks a little bit less, perhaps less exciting than gold. Here's oil. Oil is going the other direction. Heavy volume, equally as impressive volume. Now, again, this is a weekly chart and it's zoomed out, so I don't think many folks are looking at it like this. But, it's kind of in this channel still moving down. Now, again, I don't want to dismiss. It's a 12% down week, so this is a huge down week for oil. And if we really sort of take this view away, and we look here at the daily chart, well, you can see exactly what was happening since December. We've been coiling here. We've been consolidating, and we've been moving between, call it $64 and $71 on the USO ETF. And that finally broke down this week on some heavy volume. So 4 months of sideways trading has, essentially expanded and broke down to the downside. And we're now back to early 2022 levels. So oil, clearly picking up momentum to the sell side here. Again, depends on your perspective and your range and your time frame, but longer term, you can see it's kind of just back in this channel here. We'll see if it gets more follow through next week. If we throw on Bollinger Bands, you can see it's already stretching below its weekly, and on the daily chart entirely below it. So the selling there has been pretty fierce. And we'll go right down the list here because everything's making big moves. You got TLT on the long end here. Look at this, really fighting back up towards the year-to-date highs here. So this is around 108 or so. Remember, Treasury bonds, opposite of yields. That means yields going down as bond prices go up. And if we go to the weekly chart, again, you can see big volume coming in, and this looks kind of constructive here, and we'll see. Again, it's at some pretty good stiff resistance right now. We'll see if it can find some follow through next week pending Fed. You can go to the IEF as well on the mid-year 10-year Treasury, 7 to 10 year, and again, you can see coming right back up to year-to-date highs, putting in some big volume, and that's clearly some of the big moves that we've been seeing out there. Last but not least, let's just look at a couple of culprits here that's been holding up the Nasdaq. It's Microsoft. Microsoft is one of them, throwing pushing directly through the upper Bollinger Band here with this gap up on Friday. It held most of it. Look at the expanding volume to the upside, 4 trading sessions up in a row. And in those 4 trading sessions, it's up basically 14%. Remember, it's a $2 trillion company, so nothing to sneeze at here in terms of, moves. And it's coming back into a lot of previous supply in here. You've also got Apple, which is, I don't think has broken out. Yeah, it's just kind of sitting on the top here. I don't think that's really been the standout. It's really been like Nvidia here, which is pushing. And this is, again, just another one that is relentlessly charging. Look at this weekly consecutive march higher here for Nvidia. Just super impressive. And that translates obviously to semiconductors, which again are battling some pretty big prior overhead supply areas or just general stall out areas. So it's going to be interesting to see as a lot of these big heavyweights, which really are the ones that are dragging up the Qs here. And again, as we looked at the equal weight and breadth, you can see the average stock is not doing as good as, say, those 3 heavyweights, which are pushing things up. So I think that's everything. Lots going on out there. Again, know your risk and tolerance and time frame. It's going to be a busy week. We got Fed decision out on was it Wednesday, and so we'll see how the market takes this and see how aggressive it's gotten in terms of pricing in those rate cuts. I'd love to know your thoughts. Let me know in the comments below. What do you think about this Q's outperformance here? Are you buying it? Are you buying the rate cut narrative? Do you think the Fed is done? Leave a comment below. Let me know where you stand. And as always, I want to thank you for tuning in every Friday. Long form market analysis just like this. Try and keep it objective, and hopefully it is helpful. So have a good weekend, and we'll see you back here next week.